Okay, well, welcome everybody. My name is Paul the Alien, as if you didn't know, but just for those that don't know who I am a real alien. And I'd like to introduce myself. So this is my disclaimer. So I've been working in the oil industry for about 12, nearly 13 years. And I've observed many things, learned a lot of things since I started working for Chevron in California as a systems admin. And what I do during the day, if you don't know, is I make sure that the computer system behind the 8,000 gas stations that Chevron has out in America and Mexico are able to transact payments from credit cards, ATM cards, and fleet cards, all kinds of different things. And it's quite a complicated business. And I've also come to understand how the business works somewhat, not completely. It's extremely complicated and nobody really understands how it works from one end to the other. So anything I say here is just my own opinion and my own observation over the last 10 years or so. And I do actually trade Chevron stock. I have it in my 401k plan with the company. I own it and I trade it. So there's two different things I do with it. I own it for the dividend. I also trade the stock between the levels in another account, sometimes in my 401k account with Fidelity. Okay, so that's that out of the way with. So the oil industry, but before I start, this is what I'm going to be talking about today is fundamentals, nothing to do with trading as we know it in the pit. There's going to be no tape reading or analyzing price action. I'm really interested in short, medium to longer terms, weeks, months, years. And Beach Boy, I was making fun of Beach Boy earlier because he's a fundamentalist trader, and so am I. I just like to change my hat every so often and come at things from a different aspect than just day trading and swing trading. And, learning from Stephanie all about entries and exits has helped me immensely with my longer term trading. And I'm applying that to the oil industry and seeing what opportunities there are to make money in the oil industry, because the oil industry is very interesting. First of all, it's not one industry, as most people think. It is actually several industries. And there are three main ones. There used to be really only two. There used to be upstream and downstream. And now it's kind of segmented itself into like three separate industries. So upstream is everything basically from the under the ground to the refinery. So that includes geological surveys, drilling for the oil, manufacturing the oil rigs, all the components of an oil well. Manufacturing is really the refining system. So in Texas is where most of the refineries are in the United States. There are many, many, many refineries down there. If you drive from Houston all the way down towards, what's the name of that town south of Houston that got wiped out by the hurricane a few years ago? I forget, but there's just refinery after refinery after refinery. And if you drive down there at night, it's like amazing experience if you've ever done it. Just driving past them all, watching all the gases flaring out of the tops of the cracking columns and stuff like that. Brownsville, Galveston. Have you ever been to Galveston? I visited Galveston about 10 years ago, and there was a big hurricane. I think was it Andrew? Or I can't remember. It went right through, and it just basically wiped out all of the houses on the coast. And they've been completely replaced. And they're all on big stilts, and they're all brand new. If you drive down there, there's a big beach you can walk along. And plastics, that is retail, distribution, retail outlets, base oils, all kinds of things. Retail includes gasoline, all of the oil that you go to buy for your car to change your oil, plastics, everything. It's all part of that. Aviation fuel, all that downstream industry. Okay, so there's upstream and there's downstream, and there is a category or an industry called midstream, which is basically where do they store the oil? You know, they store crude oil. There's a huge depository for that. There's also storage of gasoline. There's the transportation of it. There's a huge network of pipelines throughout the United States. It's taken about 100 years to build it. The amount of money that is, I mean, the whole of Texas is just one huge pipeline network. And where there aren't any pipelines, there's railways trucking it and so forth. And that's how basically it works. And then on the distribution side, the downstream side, which is the area I've worked in the most, there are, well, they're called distributors. There's wholesalers. You see, I'm going to get more into this later. And then there's the retail outlets. So each major oil company, you've heard of Valero, you've heard of BP, Chevron, ExxonMobil, they all have a gas station business, retail outlets, that they sell their crude oil that they crack from their major refineries into. But basically the entire system is one big system, and there are feeds into it and out of it, and you basically pay whatever the spot prices are for the gasoline, the crude oil, the different blends of it and everything, aviation fuel, and there's a futures market that prices it. Yeah, it's a little bit hazy myself. I'm not clear exactly where the refineries are categorized. It's more downstream, I always thought, but you know, manufacturing is, what are you manufacturing? You're manufacturing a product. So it's a little bit, you know, unclear to me exactly where you put refineries in these three categories. I tend to put them more into downstream. In Chevron itself, where I work, downstream refining is part of downstream. And upstream is just basically all of the stuff to, you know, drill the oil out of the ground. The fracking industry is all in the upstream segment of the company. But they are two distinct parts of the company, and they each have different profit centers. How long? I think indefinitely, Robert. It's basically just like having an oil field, except it's immediately available. You don't have to pump it. They just put it in the ground in huge areas. I can't remember where it is now. The government controls it. It's, what's it called? The Strategic Oil Reserve or something. It's huge. I think there's something like about 700 million barrels of oil in it. But there are rules about whether or not it can be used. I think it has to have the president's approval, I believe, to even access it. Okay, moving along. So there's your three segments of the industry. So they're really separate industries, okay, with their own characteristics and profitability. And that's what a lot of people don't understand about it. It's quite complicated. They're all separate. So here is the one takeaway that I'd like you to try to understand. When you're trading oil or owning oil companies, okay, the upstream industry, okay, is most profitable when oil prices rise. Okay, that's all you really need to know. I'll go into it in detail later. The midstream activity is kind of somewhere in between. It fluctuates a lot, but they're always making money. You know, storage companies charge a certain fee to store the oil. Pipeline companies charge certain fees to transport it, and it's highly competitive. You know, trucking companies and rail companies charge fees to transport the oil to where it needs to go. And it can be gasoline and it can be crude, so it doesn't really matter. Now, the downstream part of the industry, oil prices, they become most profitable when oil prices drop. That's all you need to know. So, any questions so far about this? Does anybody, before I go on into detail? No? Okay. So, across all three industries, there are certain companies that do business in each of them, or all of them. And these are called integrated oil companies. We call them the majors or super majors. Chevron, ExxonMobil, Shell, BP, Royal Dutch Shell, and ConocoPhillips. So what they're able to do is they're able to hedge to some extent against oil price swings. So if you are invested long-term in one of these super or all of these super majors, you are slightly, to some extent, insulated from price swings in the crude oil price. That's all that means. Whereas if a company is in one sector, or one industry rather, its profitability can be affected very drastically by the ups and downs of the crude oil price. Okay, so here again is a little description of it. Now you've got the majors are in each different industry. You've got companies like Schlumberger, which is only in the upstream business. And so Schlumberger is going to make much less profits when the oil price drops. So when somebody in the pit or somebody tells you, oh, you want to invest in oil, buy a Schlumberger, hold on one little second. If oil prices drop, Schlumberger is going to lose money. Same with Chesapeake. Chesapeake is basically in the upstream business. It drills basically. It drills platform. It has huge reserves that it's bought and owns a lot of that, but it's hugely leveraged. It has unbelievably massive debt that it's trying to pay down, so that when oil prices drop, Chesapeake will go through the floor. And I wouldn't be at all surprised if this company goes out of business. Especially right now. They've been able to recover slightly as the oil price has gone up over the last year, since it was down in the 20s, 30s, after the last price slump. And but basically, as far as I can tell, Chesapeake is owned by the banks because, you know, they owe so much money to them because they've leveraged their business so much. And basically, they've got a lot of oil in the ground that they're not able to make money on because oil is not expensive enough for them to make profits. Once it rises, they will become massively profitable again, but that's a big if. That's why Chesapeake's oil share price is under $2 now a share. So you have other companies in the midstream business, truckers, railroads, pipelines. And then the downstream business is mainly what I would call refineries like Valero, and anything to do with retail. So there is a question that gets asked to me. by people who are angry about how much gasoline costs is, why is gasoline so expensive? And it's a very charged question. Here's the well, the reason ultimately, well, yeah, that's inflation. I mean, you're talking general inflation or I don't really know the answer to that. Hyperinflation doesn't really help anybody, does it? It just causes, you don't get any investment, do you? Everybody just spends money because there's no point in holding on to it. Anyway, the answer to why gasoline is so expensive is the supply chain. There are basically lots of middlemen at every level taking profit or charging for their services. There's a lot of people at the trough making a lot of money. Okay, and let me explain how this works. So there's your very, very broad, three industry picture. And so what you have are, at the one end of the chain, you have surveyors who have to be paid. You have drillers that have to be paid. For instance, an example of a driller might be that company that builds the oil rigs and rents them out to oil companies so they can go and drill for oil. Is it Oceanic, one of them? The one that built the platform that BP used when they had that accident in the Gulf. Rig companies, yeah. There's that one from Denmark. I can't remember the name. It went bust. Then there's shippers. So there are pipelines that go from underwater from the Gulf into Texas. Those are managed by certain people, by companies. They have to be paid. Once it gets into the distribution network, it then goes into the refineries, and they have to be paid for cracking the oil and turning it into gasoline and aviation fuel and all the other products like plastics and so forth that people buy. Then once it's been refined, it then goes back into the pipeline system. It goes on sometimes directly onto tankers that go to the gas stations. These people have to be paid. And there are what are called marketers who market the gasoline. They actually take delivery of a lot of this gasoline, and they then market it to gas stations. So there's another middleman in the middle here. And then there's the distributors. They have to be paid. And then the truckers as well. And then eventually the gas station takes delivery of the fuel at the gas station, or the 7-Eleven or the Walmart in case of base oil. And they have their markup. So you've got all of these people who are at the trough taking profit, making profit every point of the way along here. And no one company has control of all this. One of the things that's quite comical is when the Congress hauls in the oil executives from the big super major companies and blames them for the price of gasoline, and they have no control over it. And so it's just a little, when I watched the interrogation going on in front of the cameras in Congress a few years ago, it was when oil was at $150 a barrel, and Exxon was making billions and billions of dollars, and Chevron was making 40, 50 billion a year. They were looking for somebody to blame, and it's just a PR exercise, and it happens every so often. Well, what they don't understand is that there's a cycle to all of this. And finally, you have to pay for the gas at the gas station. And in the retail world, this is categorized as a grudge purchase. It's people do it grudgingly, but you have to buy the gasoline because what choice do you have? And it's an inelastic product. It doesn't matter how much it's priced at, it will still sell. So that's that. There again is my very rough picture of the three industries. So in the industries, as oil prices go up, right? Now, when I say oil prices, that's the spot prices of crude oil that we see on the futures market, right? What's called CL. And that price fluctuates throughout the day. And whenever a oil refinery wants to take delivery of some oil, it has to pay that price for it, depending on the blend. If it's a West Texas Intermediate crude, which is usually very light, I think it is light. It's a light blend of crude oil, and they have to pay that price. So if it starts, if the price of that oil at the pump of WTI drops, right? They are able to purchase it more cheaply. They crack it, and then the trucks come along to the terminal and pick it up, the gasoline, the different blend, depending on which grade they want. And they are able to sell it to the marketers, and the marketers have deals with the gas stations and so on. And so what happens is as the price drops, the gas stations are not able to drop the price of that they show on the forecourt as quickly as the price of oil drops, because if they do, the gas station next door, people will go to that one instead. And so this is just a kind of a feature of the market, is that when oil price drops, the retail market starts to lose money. In fact, some of these gas stations are not making money at all on the sale of gasoline as the spot price drops. It's like a few cents a gallon, that's all. And they make most of their money when you go in and buy something like a Coke or a coffee inside the building. Yep, exactly. They make more money on snacks. Now, so when you see the price of oil dropping, you don't want to be investing in companies that are in the downstream business. Okay? Did I get that round the right way? Oh, as the oil price goes up, excuse me, I got it the wrong way around. Silly me. Yeah. Right. When the price of oil rises, they're not able to raise them as fast as they can, because the volume drops off if they raise them. Oh, excuse me, it's the other way around. And as it drops, the gas stations can keep their prices high and their margins high, and that's basically how the retail gas market works. Now, it works completely the other way around for upstream. Upstream loses more money when the price of crude oil drops, and vice versa. So when prices are going up, companies like Schlumberger, their profits really start to multiply when oil prices go up. And the majors, most of the majors are more skewed towards upstream anyway, but not as much as companies like Schlumberger. This is why ExxonMobil makes so much money, because most of its business is upstream. I think about 30% of it is downstream. Taxes are irrelevant, Robert. This is purely about what they charge. I mean, the only reason taxes will affect it is it might stunt demand at the pump because consumers can't afford it, right? And it will cause business to be more expensive for the airlines, and so you might have demand falling off. That's the other thing. The airlines, they try to hedge against huge price increases in the aviation fuel. So companies like Southwest, American Airlines, they will buy futures contracts so they know that they can rely on a certain price out 3 to 6 months, so that they can predict what their business and future costs will be. So it doesn't always follow that a price increase in the crude oil will affect airlines as much as some people in the pit think they will. I'm always amused when I hear that. Oh, I'm going to buy American Airlines because the price of oil is dropping. No, it doesn't work like that. It's not a direct one-to-one relationship. And of course, some of them, Delta. Oh yeah, I heard about that, yes. I heard that Southwest, when the oil price went from $40 a barrel to 140 5 years ago, I heard that Southwest had hedged aggressively, and that's the reason why their share price went so far up so fast, was they had that big jump on all the rest of the industry because of that, because they were hedging oil prices, aviation fuel at a certain value, and it was like much less than when they took delivery of it. The price was like 2 or 3 times as much. So that's the other use of futures, is they actually use them to take delivery, of course. Now, so not safe for work. Investing in oil companies is risky. Okay, enough said. Okay, because one, the first thing about oil is it's an extremely dangerous and toxic compound. Okay, it's flammable, it burns, it's toxic to anybody who touches it if it gets into the ecosystem. And we all know about the lawsuits and things that happen as a result of that. It's difficult to keep it contained. It really is very difficult to keep it contained. There's a lot of money needs to be spent to stop it leaking out of refineries, valves, oil pipelines, ships, you name it, anywhere in the system. There's also the geopolitical goings-ons. It's also risky because the oil industry is one of the most highly capital-intensive industries there is. It's absolutely incredible how much money it's needed to drill for oil. It's unbelievable. If you look at the balance sheets of most oil companies, you look at the debt that they have, it's humongous. Then there's currency fluctuations, the dollar. And the other thing is the whole world economy is run off of it. There's no doubt about that. And then the fourth or the eighth reason it's risky is because of price manipulation, which I think we are all starting to learn about. Okay, so the question is, why would we ever invest in it? JR, okay. Why would we invest in it? Anybody like investing in oil? Lorraine, you don't like it? Oh yeah, Steph, you do. Why? Why do you like investing in oil? Wouldn't it be safer to invest in something else? Or trade something else? Diversification, yeah. That's a very good reason. It's a huge part of the economy. Well, let me go to the next slide. You want to trade it better, Yeah, I like to trade it. I like to do both. I like to hold it and trade it. I'm going to go into that later. So 9 years ago, British Petroleum Deepwater Horizon drilling rig exploded off of the coast of Louisiana, causing the worst oil spill in U.S. history. It killed 11 people, and it took nearly 3 months to stem the flow of oil out of the bottom of the ocean. And look at what happened to their share price. It went from just above $60 in half in a period of about 2 or 3 months. See that? See that drop there in 2011, was it? 2010? 2010, yes, April. And it was always in the news. There were lawsuits, the government was involved, accusations flying back and forth about who's at fault for all of this. So the reason we invest is its profits are potentially huge in this industry, okay? However, they're completely dependent on the price of oil for the most part. And there's this dance going on between the production and the supply, OPEC, Russia, shale now. So really, most oil companies are really in the business of managing capital. And what I mean by capital is oil reserves, if they're in the upstream business, debt, expenses and income over a long time frame between discovery to selling the oil into the market 5 to 10 years later. It's an extremely long-term business which goes through periods of boom to bust. Okay, so that's the first thing you need. That's really one of the things you need to know is it goes from boom to bust very quickly. And you really have to, if you're going to invest long-term, you have to pick good companies that are well capitalized and can withstand the ups and downs of the oil market. And so this is the price of oil over the last 70 years. You notice it was around about $20 to $30 for, from the end of the war to the 70s. 73, we went through the oil shock where it tripled in price from 20 up to 60 almost. And then it went sideways for another 5 or 6 years. And then it went up to $140 a barrel, 120, 130. Then it came all the way back down to $30 in the mid 80s. And then it's been doing, it's more gyrations, 40, 30, 40, up to 80. And then we had that huge spike up to over 160 in, I think it was 2005, that was. And then the oil price collapsed in half again, less than half, more than half. And then it went up again. And now we're back down in the $40 to $60 range. We had a spike up to 70 something, and now we're back down under 60 again. So it's an incredibly volatile market. It has a lot to do with wars and things like that. And technology. Technology has changed a lot in the last 5, 6 years, 10 years. So again, those are the main reasons. So how do we trade it? Okay. I'm 59 years old and I can't afford to lose any money. So I basically have a risk on, I'm risk on always with oil investing and trading, mainly with investing in it. I don't buy small fly-by-night speculative oil stocks, especially not upstream, because these companies go in and out of business like crazy. Like, it's just unbelievable, the turnover in these companies. It's rife with, speculators hoping to make a quick killing in the stock market. Fracking is a classic example of it. Many of these companies go out of business. I buy mainly large conservative companies across multiple industries. For example, I wouldn't touch Occidental with a barge pole because it's an upstream company. And it's highly leveraged, has a lot of debt, and it's been in the news recently after it was in a bidding war with Chevron to buy Anadarko. So my strategy is to dip a toe in and add to them. That's my strategy when I buy a stock. So even if it's Chevron, I just buy a few shares in it and add once I see directional plays. So I wait until it's at a certain price or a certain level, I buy it, and then I add to it if it keeps going, momentum. So I always keep a base amount of the stock and trade up and down from that and take profit in and out, in and out. So I buy it and I trade it. And I use very tight stops, usually. Because one of the things I've noticed is that when oil reverses, it usually does it fairly quickly. So I cut my losers off quickly, immediately, get out, and then wait. So I sell some. I always have a base amount, but I sell some and get back in at support levels. And I use I learned from Stephanie to have a target, scale out 3 quarters, keep the last quarter, let it run, of the amount above my base amount, all right? Because the reason I like to have a base amount in all the time is because I'm always getting a dividend on it for the ones I'm interested in, like the majors, like Chevron, for example, it has a 4% yield. I don't care if the stocks keep rallying and doesn't stop. I just take my money and I run, and I wait for pullbacks because I know they will pull back. There's so much speculation in the oil market. So that's basically how I trade oil. I'm sure you have your own methods, but I thought you'd just like to know the way I do it. Any questions about that? Hold on. I think I've reached the end. Yeah. I mean, the main takeaway that I don't think many of you have heard about is this. The 3 different industries. It is 3 separate industries, essentially. So what I would advise you or recommend you do is when you check an oil company that you're interested in, find out which one of these 3 sectors it's in, or if it's in all of them. See, there's Devon. Devon's another driller. I was looking. It's actually I find it very complicated. Even now, things about this industry, I just look at it and perplex me. It's highly technical. The relationship between the what is it? The relationship between marketers, distributors, and so on is highly competitive. I mainly buy the stocks, Donda. The reason I do that is because it's more longer term investing and options are harder to do. You'd have to buy options that are much, much further out. Just my own personal preference. I don't have to be continually fighting the decay. Yeah, MRO is not a company, is it? No, it's Marathon Oil. Yes, it is a company. So excuse me. Marathon Oil. Marathon Oil. Let me look it up. Let me punch this company up. I used to know about them. It kind of gone off my radar. I really only do Chevron because I know it so well. I'm usually pretty close. I don't have any inside information on it as such, but I kind of know how well it's doing in each of its businesses just by listening to the company propaganda and with a pinch of salt. I mean, they always say positive things, but that's the way they are, obviously. But I can kind of read between the lines. And also I know, you know, the hiring, stuff like that. Right. You see, right now, the price of oil is under $60 a barrel. It's what, 55 right now? And dropping. It may have found some support. But if, I mean, did you notice the prints, the massive prints we had on oil a couple of months ago? Yeah, I mean, it's very interesting. I think oil, it all depends on, it's going to depend on several things. One, it's going to depend on worldwide growth. Okay. If the world keeps in a bull market, the demand for oil is going to still be there, and so that will pressure the prices up. If we go into recession in any way, price is going to probably go back down to the 40s. Okay. Now, the other thing that is going on here is that it's extremely cyclical. I haven't actually done any slides on this, but I can explain it to you. An oil company has to first explore for oil, geological surveys. Then they guess if there's oil down there. They then have to do exploration drilling. I don't know the exact percentage, but I think the chances of the new wells actually producing oil is it's a chancy business. You have to spend a lot of money to drill them, and not, you know, it's like, I don't know, 1 in 10 chance or something that you actually strike oil. Then, but when you do strike oil, usually there's a lot, right? And at that point, you make a lot of money, but there's a lot of risk, you know? And so that's where the initial investment goes. So it takes from the beginning to you know, researching and drilling, it can take 10 to 15 years before you make any money out of it. Now, if you have a situation where the price of oil is very high and your company has got a lot of capital because it's been making lots of profits, right? It's able to reinvest that money into going out and finding oil and drilling for it, right? What every company does in the business is figure out, okay, how much is it going to cost me to drill this well, and what price of point of oil will it be profitable if I manage to strike oil? And so every company, ExxonMobil, Chevron, ConocoPhillips, Royal Dutch Shell, they are trying to predict the future price of oil, and they have whole departments to do that. We have one in Chevron where they estimate the price of oil so that they can decide whether or not going after oil in this area is going to be profitable or not for them. And if they don't think it's going to be profitable, they won't do any investment. So what happens is that when oil drops in price and it looks like it's going to be weak, oil companies stop putting money into looking for oil. Now, the other thing going on at the same time is all the old oil fields that are producing oil, over time, the amount of oil coming out of them declines. This is just a physical limitation of an oil field. It has a begin cycle, a plateauing cycle, and a down cycle. Every oil field is the same. Doesn't matter where it is. And so what happens is, over time, oil companies have to replace their oil reserves, known oil reserves, with new discoveries. If they stop investing in looking for it because they don't think it's going to be profitable, 5-10 years down the line, the amount of supply of oil is going to dwindle automatically. There's a dwindle rate in the industry which has to be replaced every year by new discoveries. And so what happens is, if you have a prolonged period of time where the oil price is deflated, there's going to be a time where production is not going to be able to meet the demand once the demand comes back. And that's when oil prices go up. And that's what has been happening. There has been massive underinvestment in oil the last few years, if we take fracking out of it. See, fracking was the thing that really upset the whole market because it completely upended the relationship. Before fracking came along, there wasn't really any way of getting very huge quantities of oil into the market quickly. Fracking changed that whole thing. And so, but eventually, the piper has to be paid, right, for underinvestment. And when that happens, the price of oil will spike because supply and demand. And that's the reason why the industry generally goes through these boom and busts, because they boom while they do a lot of exploration and investment, right? The oil comes on the market, they make a lot of money, hopefully the price goes up, they make lots of money, and then the oil price turns and goes the other way, and then the industry stops making money. And this up and down is what causes the fluctuations in supply and demand. So the risk is that in 5 or 6 years' time, we won't have enough production to meet demand. But I don't know exactly. You have to ask a real oil expert on that one. And they all come up with the different ideas. You'd have to subscribe to an oil magazine and read it every month to find that kind of information out. Okay, anybody got any questions? Any more questions? Fracking, Saudis had control. Yeah, that's right, the Saudis did have control. Not anymore. But you know what? There is a limited amount of oil in America under the Permian Basin where all the fracking is being done. It's not unlimited. Eventually, once that starts to decline, watch out. Who knows how long that will be there for? 5 years? 10 years? I've heard that it'll be there for 15. And then then it'll start to dwindle. And the interesting thing about fracking is the oil wells are not, they don't dwindle the same way. They fall off the end of a cliff. It's like suddenly you're at maximum production and then boom, it's gone. It's not like a traditional oil well where it's like a bell curve. Yeah, the average fracking field lasts 3 to 5 years, you're right. And there are thousands of them. Yeah. It's the things they don't say that I find interesting. You know, you have all the people who are, you know, boosters who go on and on about, oh, fracking industry is going to reverse everything. It's going to mean America is going to be strong, blah, 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 blah. But they don't tell you about when's it going to end. Of course, naturally, that's the way people are. My own opinion is it's probably given America a 15 to 20 year breathing space where it won't be reliant on foreign oil. But we had better replace it with something else, or we will be right back in the same situation we were in the 1980s. You know? Yeah, but Beach Boy, it's also what kind of oil, right? It's not a completely what's the word? Continuous market. There's heavy oil and light oil. Light oil is easier to refine, but a lot of the refineries are tailored to refining heavy oils. Now this is where you know, it's complicated. It's a very complicated set of industries. It's not as simple as saying oil prices are going up, I'm going to buy an oil company. You got to do a little bit more research than that. But I hope I enlightened you a little bit on the three different industries, and you know, you just have to just basically find out which one the oil company you're interested in is active in, and use my formula, which is whenever oil prices are going up, upstream will tend to make more profits. Whenever oil prices are going up, downstream will make less profits. In Chevron, the last downturn we had in oil prices, the upstream division lost money. The downstream division made much more money, and vice versa. This quarter in Chevron, I think last year, downstream made 200 million, 250 million or something like that. Upstream made about 2 billion or $3 billion. I mean, 2 or 3 years before that, downstream made about 1.5 billion and downstream lost 500 million or something like that. But Chevron is actually more engaged in doing gas exploration and liquid natural gas in Australia now. All of that stuff is coming online. They're selling it into Asia. But natural gas, its price of it is so low right now. They invested heavily in it when price of gas was high, and now it's dropped. So they made a bit of a mistake. See what I mean? They weren't able to make as much out of it as they thought they would. Okay, I think I'll probably end it there and wish you all a very nice weekend, and we can start the music again. Stop recording. Yep, there we go.